Hello everyone, I hope you guys are doing well and studies are going in full swing. In today's video, we would be discussing an important chapter for CA Final AFM, that is mergers and acquisitions. It's one of those chapters where you can score marks. The questions over here are a lot more manageable and a lot of scoring possibilities over here. So let us get started. We'll do all the important concepts and all the important questions as well. Again, the source over here would be from your AFM shield, the theory part, and the sums from your Super 90 file shared on Telegram. So let us get started. So in this chapter, there is a bit of theory at the beginning on what are the advantages of the merger, what are the various types of mergers, quickly kind of running through them. So you will have a horizontal merger where you acquire a competitor, a vertical merger where you acquire, let us say, a supplier or a distributor. Let us say a conglomerate merger where you're acquiring a company in some other space, a reverse merger where a bigger company gets acquired by a smaller company, or a loss-making company acquires a profitable company, and so on. In terms of the objectives of the merger, one of the core objectives is always the synergies, that is 2 plus 2 equals to 5. That is, if two companies are operating separately, earning a profit of 2 and 2, then coming together, they can earn a higher profit, let us say, of 5 rupees combined due to cost savings, etc. Apart from that, various other objectives are also possible, something like increasing your user base, getting access to a better technology, accessing a new geography. All of these are also other possible objectives of a merger. Another very interesting objective of merger can be in case of increasing market price, where a high PE company acquires a low PE company and the market price can possibly change if the PE ratio were to remain the same. So at this point, a very important thing has to be figured out from an exam perspective on how do you calculate a lot of post-merger data. One of the most common things that the institute usually asks you regarding post-merger data is calculating post-merger EPS. Now, how do you calculate post-merger EPS? Well, post-merger EPS is nothing but the total of pre-merger PATs, profit after tax, for both the companies, that is pre-merger PAT of the acquirer plus the pre-merger PAT of the target, plus synergies if any. If there is no synergy given the question, you can assume it to be 0 divided by the post-merger number of shares. While calculating post-merger number of shares, you will take the pre-merger number of shares of the acquirer, which remain as it is, plus the pre-merger number of shares of the target into the exchange ratio. Like for example, if target has 10,000 shares and the agreed exchange ratio is 0.5:1, that is 0.5 shares of the acquirer for every 1 share of the target. That means 10,000 into 0.5, that is 5,000 shares of the acquirer will be issued to the shareholders of the target. So in case of a share swap, in the numerator you have the combined earnings plus the synergy divided by the denominator, you will have the combined post-merger number of shares after applying exchange ratio to the target shares. This is usually the case. Most of the sums do come regarding calculating post-merger EPS in case of a share swap. Sometimes it might be possible that you are supposed to calculate post-merger EPS in case of a cash acquisition. In case of a cash acquisition, still, if you were to acquire a target company by paying cash, your numerator will have post-merger PAT, which is the pre-merger PAT of the acquirer plus the pre-merger PAT of the target plus the synergies. But in the denominator, you will not issue any new shares to the shareholders of the target because you are paying cash, and hence you will not have any shares issued to the shareholders of the target. However, you are paying cash, and that cash, if you don't have, you will have to borrow, in which case you will have to subtract interest, and tax adjustment, if any, should also be considered, or that money must have been deployed somewhere and must be earning income. It will no longer earn income, and hence that income foregone will be adjusted in the numerator in case there is a cash acquisition. That is something that you have to remember. In case the question asks you to calculate post-merger EPS, whether it is a cash acquisition or whether it is a share swap, when you go to post-merger market price, this is an important piece of information. While calculating post-merger market price, first you will see data given in the question for calculation of post-merger market price. If the question gives you data regarding future anticipated growth rate, like it tells you that earlier the growth rate was 6%, after the merger it is likely to be 8%, in such a case, you will always calculate the post-merger market price by taking the Gordon's formula. While you estimate the dividend, find the KE minus the revised growth rate, and if the data regarding growth is given, you will always take that for the purpose of finding the post-merger data. However, what if the data is not given? And we will see sums on what should be done if such a data is given. What if such a data is not given? In case such a data is, let us say, not given, then you look for other pieces of information. Like we will say that like the post-merger PAT is nothing but the total of pre-merger PAT. If you have been given data like Day Limited acquires Night Limited and Night Limited's current market value reflects its true value, In which case you will say that post merger your value will be the pre-merger market cap of day plus the pre-merger market cap of night. Or sometimes a question might tell you, like there's a sum where say Elrond, who is an acquirer, acquires Doom, who is a target, and the total gains on account of merger on a present value basis are 200. So you will say post merger I will have Elrond, market cap of Elrond, plus the market cap of Doom, plus 200 rupees, which is the total gains. So in case data is given in the question on how to calculate the post merger market price, different growth rates given, use that for the purpose of finding the post merger market price. Data given on what will be the post merger market cap, like the target's market cap remaining the same or it increasing by 200, use that. But if nothing is given, then you can find the post merger market price using an alternative method, that is post merger EPS into post merger P will give you the post merger market price. Ideally the best valuation method is the Gordon's formula, d1 by k minus g. If it is possible, take that. Otherwise some other method which was based on the PAT concept, like pre-merger PAT plus pre-merger PAT of both companies, so pre-merger market cap plus pre-merger market cap of both companies plus gains if any. But even if no such data is given, in such a case we can say that well, post-merger market price can be calculated as post-merger EPS into post-merger P. Post-merger P can either be assumed to be the same as that of the acquirer, which is a common assumption that the institute takes, or it can be assumed to adjust to the weighted average P of the acquirer and the target, where the profits are taken as weights. Remember, from an exam perspective, you will first see if there's data of growth not available. If there's any other data like gains, etc., not available, then you take the post-merger PE to be the same as the PE of the acquirer, unless the question tells you other way around. So over here there can be possible gains in case a high PE company acquires a low PE company and the PE ratio is assumed to remain the same, then there can be future possible gains as well. So there are quite a few problems in the institute material for these. Next you go to exchange ratio. While determining exchange ratio, the ratio that you will take is for a favorable financial factor. What does a favorable financial factor mean? Higher the better, like EPS, higher the better, market price, higher the better, book value per share, NAV per share, higher the better, capital adequacy ratio, higher the better. For these favorable financial factors, your exchange ratio will be calculated as, for example, EPS is the relevant base, EPS of the target upon EPS of the acquirer. Like for example, if the target has an EPS of 50 rupees, acquirer has an EPS of 100 rupees, which means we will say that if I want to find the exchange ratio, this will be 50, that is target, upon 100, that is acquirer, that is 0.5:1. Logically this makes sense because one share of the acquirer, one share of the target. How do you read this? How many shares of the acquirer for one share of the target? So for one share of the target, we will say there are 0.5 shares of the acquirer that need to be issued. That is what you mean by the exchange ratio of 0.5:1. This will work in case of favorable financial factors. However, in case there is adverse financial factor, what do you mean by adverse? Lower the better. Like for example, NPS, non-performing asset, lower the better. Let us say there is target who has an NPA of 10%, acquirer has an NPA of 5%. If I do target by acquirer, my exchange ratio is 10 by 5, that is 2:1. Well, that does not make logical sense because you are saying that for every one share of acquirer, you need to demand 2 shares, for every one share of the target, you need to demand 2 shares of the acquirer. Here, but it is NPA, lower the better. And as a result, the exchange ratio will be acquirer by target. Acquirer is 5%, target is 10%, and hence the exchange ratio will be 0.5:1. This is quite important and particularly useful in sums where you are asked to calculate a weighted average swap ratio. You will be given 4 or 5 factors because here we are assuming that the exchange ratio is based on one factor only, maybe EPS, maybe market price, maybe VVPS. In practice, there might be different factors and hence you will look at all of these factors and then assign weights to each of these factors. But while doing so, some of them may be favorable, most of them rather will be favorable, some of them will be adverse. So for favorable factors, it is target by acquirer, for adverse factors, it is acquirer by target, and based on that, you will try to calculate what is called as a weighted average swap ratio based on the weights and then get your swap ratio for the purpose of your calculation. Next, you have a couple of cases where sometimes the institute says that what should be the exchange ratio if you want to maintain the EPS, then the exchange ratio should purely be based on EPS. What should be the exchange ratio if you want to maintain the market price? Then the exchange ratio should purely be based on market price. So if you want to maintain a particular financial factor, exchange ratio should be based on that factor. Further, sometimes the question asks you to do impact analysis or to find the gain or loss. Gain or loss if your transaction, for example, goes through. Now, that impact can be calculated as the post-merger market price minus the pre-merger market price or post-merger EPS minus the pre-merger EPS, or post-merger book value per share minus the pre-merger book value per share. So you'll do post minus pre, and then you will get a gain if positive, loss if negative. Now the challenge over here is, in case of an acquirer, pre-merger, one share of the acquirer was there, post merger that shareholder still holds one share of the acquirer. But let's say if the exchange ratio was 0.5:1, then for target, if pre-merger I was holding one share of the target, post merger I will not be holding one share of the acquirer, I will be just holding 0.5 shares of the acquirer. And hence for target, if I want to do impact analysis, I will take the exchange ratio adjusted price, exchange ratio adjusted EPS. For example, like if my post merger market price is 100 rupees and if the exchange ratio was 0.5:1, I will say that, well, 100 rupees is the price for one share of the acquirer post merger. However, we are holding 0.5 shares of the acquirer as a target shareholder, and hence our equivalent price, like in EPS, if you remember, you convert into partly paid up shares into equivalent fully paid up shares. Similar to that, we are trying to say that one share of the target is equivalent to 0.5 shares of the acquirer. So if one share of the acquirer earns 100 rupees, 100 into 0.5, that is 50 rupees will be attributable to the target, and accordingly you can do the impact analysis. We'll do sums on this as well. Okay, then you calculate the post-merger market price when different growth rates are given. In typical questions where different growth rates are given, you will first try to find the post-merger market price as the post-merger market cap divided by post-merger number of shares, and post-merger market cap will be based on the expected value of the acquirer post-merger plus the expected value of the target post-merger. Now, if there are different growth rates under the new management, like under the targets management you are growing at 6%, acquirers management you will grow at 8%. So you will say that, okay, what is the value of the piece of business that target has? For example, we will try to find the KE. Question, if it gives you KE using CAPM, you will take that, if not using Gordon's formula. However, in that Gordon's formula, you will first take the KE based on the existing growth rate. Why? Because today's price that you see in the market is based on the existing growth rate of 6%. However, unless given otherwise, we can say that the KE remains the same, and hence post-merger also the required rate of return, unless given otherwise, will remain the same, but now the growth will change, and hence the value of the target will be restated, and we will do sums on this. So you will, step 1, calculate the existing KE based on the given data. If CAPM is there, you take that. If not, you will use a Gordon's formula, which is typically the institute question, D1 by P0 plus existing G. Assume that the KE remains the same. Post merger, the value of the target's piece of business will be D1 by existing KE, which remains the same, minus the revised growth rate. Now this will give you the revised value of the target's piece of business, and when you calculate the post merger market price, you will take the expected value of the acquirer's business plus the expected value of target's business. This will give you the post merger market cap divided by post merger number of shares, and that is a post merger market price per share. Okay. This is what you will have to do. Some questions might ask you to calculate premium. Premium is the excess amount paid to the shareholders of the target over and above their pre-merger value. If you want to do the premium on a per share basis, that is the post-merger market price or market value which will be there with the target's individual shareholder minus the pre-merger market price per share. If you want to do it for all the shares, then you will try to find the pre-merger market cap of the target, compare it with the wealth that the target shareholders will have post the merger, and that will give you the premium. In case of a cash acquisition, it is directly cash paid minus the pre-merger market price of the target shareholders. In case of a share swap, you can try to find the post-merger market price per share of the shares that you are issuing into the number of shares that you are issued. So that will give you, for example, the total value of the shares minus the pre-merger market cap, and that will give you the premium, the excess amount to be paid. Now the next step over here would be evaluation of merger using discounted cash flow technique. This is largely an overlay with the valuation chapter, especially valuation of equity, where you use free cash flow method or Gordon's method to find the value. So we will say how much is the maximum value you will be willing to pay. So we will say that is based on the cash flows that the target can generate for me. So that is the present value of the expected future cash flows. Can be free cash flow to equity, can be free cash flow to firm. If the data is available, you will take that. That is for, let's say, 4 or 5 years. Beyond that, all the way up to perpetuity, that is a maximum cash flows that will come under your fold. Over and above that, because the firms are combining, there is a possibility of a synergy, in which case present value of all the cost savings or synergies should also be separately added. Or there may be certain unrequired assets like office space, etc. is not required, and you will sell that office space. So the present value of sale proceeds from these unrequired assets will also be added. And if there are any liabilities that are taken over and paid off, then those liabilities will be deducted. That will give you the maximum purchase price. Free cash flows plus the cost savings plus the sale proceeds minus any liabilities will give you the maximum purchase price to be paid to the providers of capital. If there's any acquisition cost, we will subtract the acquisition cost as well. Separately, we will say that this is paid for the providers of capital, out of which a part of which may be paid for the debentures, a part of which may be paid for the preference shares, and the remaining will be the maximum purchase price for the equity. You compare this with the price demanded by the equity. If the maximum purchase price is 100, price demanded is only 80, in which case the merger is advisable. But if the maximum purchase price is, let's say, 100, the price demanded is 120, the merger is not viable. Okay. In case of minority investment, one needs to remember that you don't really need to take the synergies, cost saving, dispose unrequired assets. But in case of a majority stake, you will consider that and the cash flows that you are expecting to get if the merger goes through. In some questions, they don't really give you the cash flows of the target. Like there's a question of yes limited and no limited in your material where they give you yes is acquiring no, and they don't give you the cash flows of no limited, but they give you the cash flows of yes pre-merger and the cash flows of the post-merger entity. And hence, we will say that the difference of that is attributable to the acquisition of no, and that is the maximum price you should be willing to pay for no limit. Okay. Next, you select the appropriate discount rate. Ideally, if nothing is available, you are discounting the post-merger cash flows, and hence, if you get the post-merger cost of capital, you will use that. If that is not available, then you can discount using the pre-merger discount rates. However, the first preference is always the post-merger discount rate of the combined entity. Next, there are certain alternative valuation methods like the comparable company analysis, where you will take a multiple of your comparable company. Like I'm Parle, I have a comparable company like Britannia, so I will try to find the P ratio of Britannia which is listed, multiplied with my EPS, or I will find some other ratio like capitalization or EV by sales, EV by EBITDA, EV by assets, and then multiplied by my multiple to get the value of my company. Over here, there might be 4 or 5 different parameters or multiples that will be used, in which case you will try to take the value under each of these methods, and then whatever is the total value is basically a sum total. So you will take, we will do a sum on this again, that what is the total value as per EV by sales multiple, then EV by assets multiple, and so on. And then you have 4 or 5 different values, take an average, that will be the final value. Similarly, you can also do precedent transaction analysis. Over here, instead of taking comparable companies, you will take comparable similar transactions. Like if you are looking at the valuation of an airline company, you will take some similar precedent transactions happening in the airline space, where let us say Singapore Airlines has acquired Vistara or Tata has acquired Air India, etc. And hence, you will try to find their multiples, take the average multiples and apply it to your answer. Then there is something called as the chop shop approach, sum of the parts approach, or breakup value approach. Over here, you will have 3 divisions. For each of these divisions, like Mahindra has 3 different divisions. I don't have a direct comparable company to Mahindra, but for each of the divisions, I'll have a comparable company. So I'll try to find the value of each division separately, as if it's a separate company, and the valuation of Mahindra will be the sum total of all of its parts. That is called as a breakup value or a chop shop method. Then there is a concept of economic value added. Now, to be honest, this is a concept that has come at multiple places. It has come in the mergers and acquisition chapters, and a lot of the literature is also there in the business valuation chapter. Now, when you are revising it, well, you can either revise it along with business valuation, or you can revise it along with mergers. In the exam, it does not really matter which chapter it pertains to. So, if there's an EVA question, you will solve it as per the method for EVA, which is EVA is economic value added, a formula which is recommended by a specified US institute like Stern Value Research, where they have said that EVA is calculated as NOPAT, that is net operating profit after tax, minus the invested capital or capital employed into the WACC. How do you calculate and what does this formula indicate? NOPAT actually indicates the actual operating profit that is earned by the providers of capital, that is debt and equity both, but that is an accounting profit. You're not considering any opportunity cost. It is like saying that if I start a business after I complete my CA and I earn 10 lakh rupees, I'm really happy as at an accounting level my PAT shows 10 lakhs. However, at an economic level, I want to see that if I had not done my own business, what would I have done? Probably I would have taken up a job where I would have earned 12 lakh rupees, and hence 2 lakhs, 10 lakhs I'm earning minus 12 lakhs if I had taken a job, so negative 2 lakhs is my economic profit. It's my loss actually, because I took up a business. In a similar way, I would say that I am earning, let us say, 100 crore profit. However, my providers of capital have provided me, let's say, 500 crores of capital. 15% is their minimum required rate of return, and hence, even if they put that 500 crores somewhere else, 500 into 15% comes to 75. Even if you put that money somewhere else, you would have still earned 75. And hence, I'm boasting that I've earned 100 for the providers of capital, but by the way 75 they would have earned in any case, and hence the excess 25 is the economic value added. That is my economic profit. It is like saying that in my job I would have earned 12 lakhs, but in my business I'm earning 15 lakhs, so that 3 lakhs extra that I'm earning over and above my job is my economic profit. So economic value added is NOPAT, net operating profit after tax, minus the capital employed into WACC. Now EVA is calculated for whom? Well, for the entire firm, business, enterprise, that is debt and equity both, and hence NOPAT is for debt and equity both. Two ways in which you can calculate NOPAT, either EBIT into 1 minus T or PAT plus interest into 1 minus T. Either of these two ways will give you the pool of money for debt and equity both. Minus capital employed. Well, since NOPAT is for debt and equity both, capital employed should be debt plus equity. If there's any preference shares, you will even add that both as per book values, not based on market values, because you're doing values as per the books. And WACC is the cost of debt into the weight of debt. Cost of debt is interest into 1 minus T into weight of debt plus cost of equity into the weight of equity, where cost of equity is usually calculated using CAPM. So these are the various things. In EVA, a couple of interesting adjustments might come where you have provision for bad debts, in which case in your typical NOPAT formula you will add at the end provision for bad debts as per ICI solutions. You don't really make any tax adjustment over here. Further, when you calculate capital employed, your reserves will be after deducting the provision, so you will add back the provision and hence your capital employed will also change. Another adjustment sometimes is for unrecognized assets like unrecognized patents, which you will separately add to the capital employed for the purpose of your calculations, because those patents, whether recognized or not in your books, maybe you have incurred R&D and you have spent the research cost in the P&L, but those patents are generating cash flows for you. They are impacting your NOPAT, and hence if your NOPAT is higher because of your patents, your capital employed should also be higher. So these are two common adjustments. Well, Stern Value Research has recommended close to 150-160 adjustments. Institute has not done that. For you, if you remember these couple of adjustments, that is sufficient, though most of the questions will be direct questions. Okay, there's also another concept called as market value added, also called as MVA. MVA, like EVA is as per profits, MVA is based on market values. So you will look at the market values of, let us say, equity plus the market value of debt, that is the total market value of the enterprise, minus the book value of equity and book value of debt. That will give you the market value added for the enterprise as a whole. Sometimes institute does it only for equity, in which case you will take the market cap or market value for equity, subtract the value of debt, subtract the book value of equity, and that should give you the answer. So this kind of takes care briefly about the theory level. We have close to 10 problems covering all of these aspects. So let's try to go through each of these problems where all of these areas, different growth rates, P multiple approach, swap ratio, everything gets covered in those 10 important questions in your Super 90 file. So chalo start karte. Question number 1. Following are the finance statements of A Ltd and B Ltd for the current year. Both the firms operate in the same industry. Great. So you have A and B, you have the entire balance sheet, you have income statement, and 3 important pieces of information at the end of additional information: number of shares, dividend payout ratio, and market price per share being given. Assume that the two firms are in the process of negotiating a merger through exchange of equity shares. You have been asked to assist in establishing equitable exchange terms and are required to. Now, very sophisticated English is used. What is asked is quite basic, but they have tried to package it fairly well. Decompose the share price, that is MPS, of both the firms into EPS and PE components. So basically that is EPS into PE. So you have decomposing the market price, okay, and also segregate the EPS figures into ROE and book value per share components. So there's another formula, I'm not sure whether you're aware or not. You would have probably done this, but if not, you can remember this. EPS is equal to book value per share into ROE. So basically, instead of asking you to, in simple words, to calculate EPS, PE ratio, book value per share and your ROE, you have been told to decompose the share price, segregate. Basically, 4 numbers you want to calculate. EPS, earnings after tax, divided by number of shares, that is 1 lakh. So your EPS, for example, will be 2.1, 99,000 divided by 80, and your EPS will be, I think, 1.24. Then PE components, well, this is market price divided by EPS, market price divided by EPS. So this is approximately a PE ratio of 40 by 2.1 comes to around 9. 40 by 2.1 comes to around 19.05, and this is 15 by 1.24. This is 12.1. Okay, so that is done. EPS done, PE done. And then book value per share and ROE components. Now book value per share you can do as assets minus liabilities or share capital plus reserves. Over here, if you look at assets, there is no fictitious assets, great. Minus liabilities, over here you will take long term debt that is the only liabilities, or share capital plus reserve. So basically this is 12 lakhs divided by 1 lakhs, and hence this is probably 12 rupees, and this is 8 lakhs divided by I think 80,000, and hence this is around 10 rupees. So that is your book value per share. ROE would be your profits, which is I think 2,10,000 upon 12 lakhs, and this is 99,000 upon 8 lakhs. So 2,10,000 upon 12 lakhs comes to I think 17.5%, and 99 upon 800 in percentage comes to around 12.375%. So that's about it. Acha, there may be challenges in case of book value per share calculation where you might be given fair values, then you will take probably for the NAV you will take the fair values. If there are any fictitious assets like miscellaneous expenses, then you will not consider them in your total assets calculation. Deferred tax though, if any, should be considered in line with institute solutions, but other miscellaneous expenses should not be considered. Okay, then you want to find the future EPS growth rate of each of the firms. EPS is equal to ROE, that is for A 17.5% into BVPS. Sorry, that is your EPS. EPS is RO, future EPS growth rates, that is G is equal to R into B. R is 17.5 that you calculate, B is retention ratio, that is 1 minus the payout ratio. So if the dividend payout ratio I think is 40%, then 40%, then 60% is your retention ratio. For B 12.375% if I am not wrong, and the payout ratio I think over here is 60%, then the retention ratio is 40%. So 17.5 into 0.6, 10.5% growth, and 12.375% into 0.4, 4.95%. So if you go to see for all the parameters, EPS A is greater, P ratio A is greater, book value per share A is greater, ROE A is greater, growth, most important number, A is greater. So A is having a better business as compared to B, and hence if there are merger terms, usually A will have a dominating position in those merger terms because it has a better business apparently. So point C we will come to at the end. Calculate the post-merger EPS based on the exchange ratio of 0.4:1 being offered for A, and indicate the immediate EPS accretion or dilution that will occur for each group of shareholders. So you are also asked the impact analysis. So over here, if I were to do the workings, I would say that what is my post-merger EPS? That is the total of pre-merger PAT, that is 2,10,000 plus 99,000 divided by the post-merger number of shares, that is 1 lakh plus 80,000 into 0.4, and hence that is 32,000. So if I total this is 3,09,000 divided by I think 1,32,000, and hence 2.34 is my post-merger EPS. If I want to do impact analysis for A pre-merger, I was holding a share which was having a 2.1 EPS. Post-merger, I am having 2.34, and hence there is a gain of 0.24. When I look at B, which is let us say the target, pre-merger I was having 1.24. Post-merger I am having 0.4 shares which are having 2.34, and hence 2.34 per share of the acquirer I am having 0.4 shares, and hence 0.936. So if I were to subtract, minus 1.24 comes to around a negative 0.304. This is my impact analysis. So over here, if I look at point D, 2.34 as well as 0.24 as well as negative 0.304, and the last one based on a 0.4:1 exchange ratio and assuming A's pre-merger P ratio will continue after the merger, we have been clearly told. So that is 19.05 if I am not wrong, that was the P ratio, will continue post the merger. Estimate the post merger market price, show the resulting accretion or dilution in market price. Again you want to do the impact analysis. So this is 19.05 into 2.34, which will come to there's a very clear instruction that you have to use this, so 44.58. and again if you want to do the impact analysis, I will say 44.58 minus pre-merger the shares were worth 40. For the target, pre-merger the shares were worth 15. However, post-merger, well, they were 44.58, but I own only 0.4 shares, and hence if I do this working, this is 17.83, and hence there is a gain at both level because a high PE company is acquiring a low PE company and P ratio is remaining the same. Point C is based on the operating synergies, A estimates the intrinsic value of B's share would be 20. Here B's market price is 15. If nothing is given, the best exchange ratio is exchange ratio based on market price. But over here, it is said that the intrinsic value of B would be 20. You are required to develop a range of justifiable ratios. So you'll have to have two ratios at least that can be offered to the shareholders by A to B based on analysis in 1 and 2. What would you expect the negotiating terms to be closer, upper or lower? Well, closer to A's desired terms because A is a more powerful company. So based on intrinsic value, target by acquirer, this is 20 by 40, this is 0.5, and based on market price, which the acquirer will push, this is 15 by 40, this will come to 0.375. So the range over here can be based on market price to the intrinsic value, and as a result, B shareholders will demand all the way up to 0.5. A would say that today your price is 15 and would want to give anywhere by 15 by 40, which comes to approximately 0.375, and hence this is a range. You would love to be closer to the lower end of the range because as an acquirer you would prefer to issue the lesser number of shares. So that is your answer to question 1. Next you go to question number 2. This is a question on weighted average swap ratio, an interesting question. Let us review this. Bank R was established in 2005 and is doing banking in India. The bank is facing a do or die situation and are problems with gross NPAs at 40%, capital adequacy ratio at 4%, net worth of the bank is not good, shares are not regularly traded, last week it was traded at 8 rupees per share. So all you have been given data regarding NPAs, you have been given data regarding capital adequacy ratio as well as the market price per share. RBI suggested that bank has to either liquidate or merge with another bank. P is a professionally managed bank with a low gross NPA of 5% and capital adequacy ratio of 16. Its share is quoted in the market at 128 and the board of directors submitted a proposal to RBI for takeover on the basis of the share exchange ratio. So you have the balance sheet given. A standard balance sheet you can refer. It was decided to issue shares at book value of bank P to the shareholders of bank R. In this question you have been given to issue based on book value, so we will issue based on book value. However, in the institute study material there is a similar sum where this line is not there. So institute in such a case has issued based on the face value. So from an exam perspective, if such a question comes and the question does not tell you the issue price, they can tell you the issue price based on book value, based on market value. But if they remain silent, then we will issue based on face value, that is in line with the institute's solutions. All assets and liabilities are to be taken over at book values. For the swap ratios, weights are assigned to the different parameters as follows. Gross NPA, remember this is adverse factor, lower the better. Capital adequacy ratio, higher the better. Market price, higher the better. Book value, higher the better. So these three are favorable financial factors and the first one is an adverse financial factor. If it is an adverse financial factor, the exchange ratio is acquirer by target. For other three, it is target by acquirer. What is the swap ratio based on the above weights? Well, you have gross NPA, capital adequacy ratio, everything. You don't have the book value. Book value can be assets minus liabilities or share capital plus reserves. So over here, there are no other fictitious assets. There's nothing. And hence you can take either assets minus liability or share capital plus reserves, which is 210 divided by, I think, 14 shares. And this is 6,000 divided by, I think, 50 shares. And hence, if I do 6,000 by 50 comes to around 120. And 210 by 14 comes to around 15. So if I look at every ratio, first is acquirer by target. Acquirer I think has an NPA of I think only 5% versus 40% and hence 5 by 40 comes to 0.125. Capital adequacy ratio higher the better, so it's target by acquirer. Target over here has I think only 4%, acquirer has 16%. So this is 4 by 16, I think 0.25 is to 1. Market price, target by acquirer 8 by 128. 8 divided by 128 comes to I think 0.0625 and book value we just found 15 divided by 120. 15 by 120 comes to around 0.125. So these are the four ratios and the weights. If you apply those weights as given over here, 0.125 is the first case. 0.25, 0.0625, 0.125 and if I take the weighted average it comes to 0.125, which means second part says how many shares are to be issued. Well, target has I think 14 lakh shares, right? So 14 into 0.125. So if I take full numbers this is 14 into 0.125, 1.75 lakhs, 1,75,000. You are asked to prepare balance sheet after the merger. Well, all assets and liabilities are to be taken over. So you will total up all assets. So every assets over here will be totaled up. You will total up the assets and you will also total up the liabilities. You will total up all the liabilities. But can you total up the share capital? Answer is no. Okay, so what will you take? Well, share capital is 140 plus the shares to be issued. Will you total up the reserves? Well, no. You will take the reserves of the acquirer only. Reserves of the target, sorry, these are the targets. You will take the share capital and reserves of the acquirer only. Target, share capital and reserves will not be taken over. Instead, you will have new shares as well as premium. So, to these number of shares, 500 as well as 5,500, everything else you will directly add. Assets, liabilities, directly as it is you will add. No problem, but you cannot add share capital and reserves. So you will compare and add this. So for doing this, you will compare the purchase consideration as 1.75 lakh shares issued at the book value, that is 120 rupees, and hence 1.75 into 120 comes to around 210 with the net assets. Net assets over here of the target would be around 210 again, and hence there would be no goodwill, there would be no capital reserve. However, when you issue these shares, these are shares of a face value 10 rupees issued at 120, and hence your journal entry will be, you will take over assets and liabilities of R, but you will issue shares 1.75 into 10, that is 17.5 worth of share capital, plus the remaining will be going in securities premium. So over here your entry will be net assets account debit to, let us say, the equity share capital of around 17.5 to the securities premium, that is 1.75 into 120 minus 10, that is equal to 110 into 1.75 comes to 192.5. So over here you will add securities premium of around 192.5. So when we look at my final balance sheet, the only thing that I'll have to be careful about is my share capital, which is 517.5, my securities premium, which is equal to 192.5, and my reserves and surplus, which is 5,500, which is only the acquirer. Everything else is a direct line by line addition. Now the change over here can be in case they were told that the shares are issued at face value, in which case this securities premium will not come. However, in such a case your PC will merely be 1.75 into 10, that is equal to 117.5, and your net assets taken over are still 210, and hence 192.5 negative will be what? You guys tell me. Fatapat bolo. It would be, yes, capital reserve. Now why are we discussing this? Well, because if you see the institute study material question, they have not told you anywhere that the shares are going to be issued at book value, market value. So institute has taken shares to be issued at face value, and if by the way the shares are issued at face value, then this will be taken into the capital reserve. So that is one piece of information that you should be aware of if you want to tally this with, let us say, the institute's solutions. Okay, and the last point over here, this requires some bit of understanding, unfortunately, from your audit syllabus. So you have capital adequacy ratio and gross NPA. Now how do you calculate capital adequacy ratio? Sir, हमने audit में छोड़ दिया. Okay, so how do you calculate capital adequacy ratio? It is your share capital, maybe tier 1, tier 2 capital. So it is your share capital, let's say equity share capital, plus, let us say, reserves, divided by something called as risk weighted assets. Now we don't have risk weighted assets. Risk weighted assets are based on weights given by the RBI. We don't have this. However, we can find it risk weighted assets separately for P and risk weighted assets separately for R. How will we find this? Well, we will rearrange. We will say risk weighted assets equals your equity share capital plus reserves divided by the capital adequacy ratio. Like for P, your share capital was 500, reserves were 5,500, divided by the capital adequacy ratio of 0.16. So 6,000 divided by 0.16, and you will have 37,500 of risk weighted assets. In my combined entity, that will continue. Further, for R, you will have 140 and 70, 210 upon 0.04, and hence 210 upon 0.04 comes to around 5250, which will also continue, plus 37,500, and hence 42,750 will be your risk weighted assets for the combined bank. However, that is 42,750 on the base of what? Well, on the base of 517.5 plus 192.5 plus 5,500. So that is your revised share capital in your balance sheet and reserves, and that is 14.53% capital adequacy. Similarly, the second part says gross NPAs in percentage. Now, NPAs are a percentage of advances, not of total asset, not of risk-weighted assets. They are a percentage of advances. Now, I have the advances pre. This is 3,500, but the NPA here was 40%. 27,000. The NPA here, I think if I'm not wrong, was 5%. So this is what 1350. This is what I think 3,500 into 40%. This is 1,400, which means your total gross will be 1,400 plus 1350 comes to 2,750. 2,750 upon 30,500. 2,750 upon 30,500, and that will give you around 9.02%. That is your gross NPA in percentage. So these are the two new things that you can apply over here. Like in the next question that you will study, the two new things will involve promoter stake calculation and something called as free float. Promoter, we know what it is. So like if you have Reliance, Ambani is a promoter with a 60% stake, then the free float, that is shares with other than promoters, are 40%. Just remember before you start question number 3 that free float refers to the non-promoter holding. Okay? So we will start question number 3 based on that. So let's continue with question number 3. Following information is relating to the company Abhiman and its target company Abhishek. So acquirer is Abhiman, target is Abhishek. Both are promoted by a multinational company Trident Limited, and the promoter is holding 50% and 60% respectively. So they are under the common control of Trident. Abhiman ke andar they are having a 50% stake, Abhishek ke andar they are having a 60% stake. Share capital is given, free reserves is given, paid up value per share is given, which is different, 100 for one company, 10 for the other company, and you have the free float. This is important. Free float would be non-promoter holding, which is 50% for Abhiman, and 60 minus 100, that is 40% for Abhishek, which means if I were to find the total market cap, this is 400 divided by 0.5, maybe 800 lakhs will be my total market cap, and 128 divided by 0.4 will come to 320 will be my total market cap if required. P ratio is given. If I have to find the number of shares, I have share capital, and if I have to find the number of shares, I will say 200 divided by 100, that is 2 lakh shares, and 100 divided by 10, that is 10 lakh shares. And hence if I want to find the market price per share, that will be total market cap, that is 800 divided by the number of shares, that is 400. 320 divided by 10, that is equal to 32. Once you have the MPS, you have the PE ratio, you can also find the EPS. EPS would be 400 divided by 10, that is equal to I think 40, and 32 divided by 4, that is equal to 8, for example. Trident is interested to do justice to the shareholders of both the companies, and for that the swap ratio is assigned different parameters by the board of directors as follows. Based on the book value, well, in this particular case you don't have the book value. So in the last question as well, you did not have the book value, but you have the entire balance sheet. So you take the total of assets minus the liabilities, or you can take share capital plus reserves. Over here as well, you have the share capital and the reserves, which means your total book value comes to around 1000, whereas over here as well, 1000 plus 500, that is your total book value comes to, let us say, 600. Remember, unless given otherwise, this is equal to the net worth, but that will also equal to my net assets, that is asset minus liability or share capital plus reserves. Over here, 1000 divided by 2, that is equal to 500. So this is basically, if I go to see book value per share, this is 500, and 600 divided by 10, that is equal to 60. So there are various ratios. Book value, this is favorable financial factor, higher the better. EPS, again higher the better. MPS, higher the better. So book value, everywhere you do the working target by acquirer. Target in terms of book value gives you I think 60, acquirer has 500. So this is 60 by 500 comes to, I think, if I'm not wrong, let's use a calculator only, 0.12. Earnings per share is I think 8 rupees on the base of 40, which comes to I think 0.2, and market price is 32 upon 400, which comes to I think 0.08. So if I take the weighted average swap ratio, taking all of these numbers, 0.12 into 25%, 0.2 into 50%, and 0.08 into 25%, and if you total up, this comes to around 0.15. So what is the swap ratio? I think 0.15, and there are I think 10 lakh shares, so the number of shares to be issued will be 0.15 into 10 lakh shares, which comes to around 1.5 lakh shares to be issued. What is the book value? Now, this is the only place where you have the post-merger book value per share. Almost every question has post-merger EPS market price. Here you have the post-merger book value per share. Then EPS, expected market price of Abhiman after the acquisition, assuming the P ratio of Abhiman remains unchanged and all the assets and liabilities are taken over at book value. So over here, the interesting part is calculation of the post-merger book value per share. EPS and market price, I think you should be able to solve. So the post-merger book value per share, well, post-merger book value per share will be the post-merger net assets divided by the post-merger number of shares. Post-merger number of shares are easy. There are 2 lakh shares plus 10 into 1.5, that is equal to 10 into 0.15, that is equal to 1.5 shares being issued. But you don't have the net assets. Unlike the last question, you don't even have the balance sheet. However, can we say that the net worth would be the same as net assets? So pre-acquisition, if my net worth was 1000, my net assets must be 1000. And for the second company, if it is 600, well, post acquisition there will be 1600 divided by 3.5, and hence this comes to around 457.14. Now remember, some students have a wrong perception. They believe that, sir, we are taking over share capital and reserves. No, we are not taking over share capital and reserves, but we will take over assets and liabilities. And hence, if there was pre-acquisition 600 worth of net worth in Abhishek and you are taking over everything at book values, which means there must be 600 worth of net assets as well, which would have been taken over, and hence 1600 will be the post acquisition net assets. Okay, next you have the EPS, which is I think relatively easier. That will take the pre-merger PAT, but I don't have the PAT, but I do have the EPS. So over here, if I want to find the post-merger EPS, I would say that is a pre-merger PAT. I don't have that. So 40 rupees, if I'm not wrong, was my EPS per share into there were 2 lakh shares, and there was 8 rupees, which is EPS, which was against I think 10 lakh shares, divided by again 3.5. So this is 80 and 80, this is 160 upon 3.5 comes to I think 45.71. This is my post merger EPS, and post merger MPS, where it is clearly given that your P ratio remains the same. So 45.71, which is my EPS, and I've been told that the P ratio remains the same, that is into 10, and coincidentally this is the same 457.1, which is the same as the post merger book value per share. Remember, this is a coincidence, not a necessary trend. You are required to calculate the promoter's revised holding in Abhiman. Okay, so if I want to find the promoter's holding, I will say pre-merger promoter had a 50% stake in Abhiman, which means out of the 2 lakh shares of Abhiman, 50% were held by the promoter, and the promoters had a 60% stake in Abhishek. So that is out of the 10 lakh shares, 60% were held by promoters. Now when I do the swap, they will get 0.15 shares. So Trident, which is the acquirer, or let's say the promoter, will get 0.15 shares, and hence 2 plus, let's say this same working 1.5. So I will say post merger this will be 1 plus 6 into 0.15, that is 0.9. So this will be 1.9 out of 3.5. This is 1.9 by 3.5, comes to around 54.29%. Great. So this is your promoter's stake. Promoter stake is a stake held in Abhiman originally, that is 1 lakh shares, plus in Abhishek we were holding 6 lakh shares, which get converted into 0.9 shares. So in the post acquisition entry they were holding 1 plus 0.9, that is 1.9 out of 3.5. Free float market capitalization. So to calculate the market cap is easy, that is 457.1, that is a market price, into 3.5 lakh shares, that is the total market cap. But the question says free float market cap. What is free float? The non-promoter holding, and hence this comes to around 45.71%, that is non-promoter holding. If 100 is the total, 54 is with the promoter, the remaining is the free float. So 457.1 into 3.5 total market cap into 45.71%, this is 731.29. There can also be alternative methods which will give you approximately the same answer, and also calculate the number of shares, earning per share and book value per share after acquisition of Abhishek if Abhiman has decided to issue bonus shares in the ratio of 1:2. This is read as new is to old. So if there were earlier 3.5 shares, I am issuing bonus shares 3.5 into 1/2, that is 1.75 shares. 3.5 over here will be 5.25 shares. Okay, and split the stock of rupees 5 each. Here my share as an acquirer is worth 100. If I want to split it to stocks of rupees 5 each, that means one stock, one share will become 20 items, and hence 5.25 into 20, if I'm not wrong, will come to around 105, which is 105. So if I have to calculate my post merger EPS as it is asked in the question, and post merger book value, my earnings will remain the same. So my post merger EPS would still be, for example, total earnings of 80 and 80, that is 160, divided by, instead of 3.5, I will now have 105, and my book value per share will still be 1600, divided by, instead of 3.5, I will have 105, and that is about it. So in this question, over and above the earlier question, there were two new points. First, you have to calculate the post-merger book value per share, and also you have to calculate something like the promoter holding as well as the free float market cap, which should kind of help you sail through question number 3. A lot of working is given and notes, you can refer that. Now question number 4 is a question which is similar to that of a valuation question, where you have to find the price that you are willing to pay considering the present value of future cash flows. So XY, which is specialized in manufacturing garments, is planning for expansion to handle a new contract which is expecting to obtain. That's fine. An investment bank has approached the company and asked whether the company has considered a venture capital financing. In 2001, the company had borrowed 100 lakhs, which had an interest of 10% per annum. Now this is specifically told to us. A borrowing is there in the company. Borrowing will result in an interest or a finance cost of 10%, that is 10 lakhs. The company shares are unquoted, and the firm has decided to take your advice in regard to calculation of value of the company. Company as a whole is like the firm or enterprise, debt and equity both. That could be used in negotiations using the following information and forecast. Company's forecast turnover for 2005 is 2000. That is the next year, which is mainly depend on the ability to get the new contract, the chance of which is 60%, which means there is a 40% chance you will not get the contract. Turnover of the following year is dependent on the outcome of the year up to 2005. So they are giving you a hint that this is a joint probability question. So the turnover of 2005 can be, if I calculate 2000, 1500 or 0.1. So I will take the weighted average over here, and hence if I take the weighted average, this comes to, I think, 1770. That is my average turnover considering all the probabilities. But you need to remember that the total of probability has to equal to 1. If I apply the same logic for the year 2006, I'll face a problem because the total of probability does not equal to 1, it actually equals to 3, and hence there's a joint probability setup. So over here, how do you calculate joint probability, and when will you know there is a dependent or a joint probability? If the total of probability is not equal to 1, that is, what is the chance of you attaining a 2500 turnover in the year 2006? Well, that chance is you get a 2000 turnover in 2005, which has a 0.6 probability, and you get a 2500 turnover in 2006, which has a 0.7 probability. So it is and both of them. So this is 0.6 into 0.7, and hence there's a 0.42 joint probability. 0.6 into 0.3, that is a 0.18 joint probability. 0.3 into 0.5, 0.15, again 0.15. 0.1 into 0.6, 0.06, 0.04. So if I now see, my total probability is actually equal to 1. Sorry, and in case we have to find the turnover, average turnover, that is considering all of these items. But while doing so, one needs to remember that the total of probabilities has to equal to 1. So you will do 2500 into 0.42 m plus, 3000 into 0.18 m plus, and so on. You will keep on doing this for all the items, and I think the answer comes to around 2298. That is the average turnover for the year 2006. What you need to remember from an exam perspective, not just for this question but for questions in general, is in case you were asked to find an average number and the total of probabilities does not equal to 1, then there might be something else like a dependent or a joint probability which you have to consider, and hence you will have to ensure that while you are applying the numbers, your answer has to be totaling up to 1. Following are the estimated turnovers and the probabilities. Operating cost. What do you guys think? Does operating cost include interest? No. Total cost will include interest, but interest is financing in nature, it is not operating in nature. Operating costs inclusive of depreciation are expected to be 40% and 35% of the turnover respectively for the years 2005 and 2006. So we will work a little hard and somehow try to find the turnover for the year 2005, I think, which is 1770, again weighted average, and 2298, which is again average after applying joint probabilities, from which you will subtract operating cost. Let us say inclusive of depreciation, it is 40%, 1770 into 40% comes to 708, and 2298 into, let's say, 35% comes to 804.3, let us say. Tax is to be paid at 30%. So can I say that this is a profit on which tax is to be levied? No, there is another financing cost which is interest. 100 lakhs into 10%, that is equal to 10 lakhs. So it must be included earlier? No. Interest as financing in nature will not be included. It is assumed that the profits after interest and taxes are free cash flows. A very important sentence. It is assumed that profit after interest and taxes are free cash flows, which means PAT is to be taken as free cash flows, and PAT belongs to whom? Well, it belongs only to equity, and hence PAT is similar to FCFE, free cash flow to the equity. Growth in earnings is expected to be 40% for the year 7, 8 and 9, which will fall to 10% each year thereafter. So for perpetual growth, you will have to take the numbers. So this is 2007, 8 and 9, and after that there will be a perpetual growth. So what you will try to do is, you will find the profit before tax. From this you will subtract tax at the rate of 30% to get PAT. Now usually to PAT you add back depreciation, subtract, let us say, fixed asset investment like capex, subtract working capital investment, net borrowings, etc. to come to FCFE. But the question very clearly tells you that PAT over here will equal to FCFE for simplification, and hence whatever is the PAT you get, let's say 1770 minus, let us say, these numbers, you get 1052 minus 30%. I think this is 736.4. Second year के अंदर 2298 minus 804.3 minus 10 minus 30%, and I think 1038.59 will be my PAT or free cash flow, to which every year you will add 40%. So this is, I think, 1454 in the next year plus 40%, around 2036 in the next year plus 40%, around 2849 or 2850 approximately in the next year. Now after that the growth stagnates at the rate of 10% up to perpetuity. Industry average cost of equity is 15%. So what do you have to do? Well, you have to find the value of the company. Value of the company, that is the value of the firm, will be the value of equity plus the value of debt. I know that the value of debt is 100, but I need to find the value of equity. So how do I find the value of equity? Well, I'll have to find the present value of these 5 cash flows. As we wrote, these are the 5 cash flows, but then this continues up to perpetuity. So over here, value at end of year 5 will equal to free cash flow to the equity for year 6 divided by KE minus G. But I need to find the present value, and hence I'll have to multiply. Well, this is present value at the rate of 15% for the 5th year. So this is 2850 approximately into 1.10 upon KE, which is 15%, minus G, which is 10%, into 0.4972. So if I do all of these workings, you will come to around 31,173. So we will say that the total value is 4,962 plus 31,173, and hence your total value comes to approximately 36,135. But that is value of equity. If you want to find the value of the firm, add debt, and that will give you the value of firm. These days institute, in case cash balances were available, is taking net debt, so it will add the debt, subtract the cash balance if any to find the answer. In this case there is no separate cash balance given. Okay, so this is question number 4, more of a valuation question rather than being a merger question. Next is question number 5. This is an interesting question in mergers where different growth rates are available and growth rates change because of the merger, and also there is a possibility of a cash acquisition in this. So very good question, something which can possibly come in the exams. Now AFC Limited wishes to acquire BCD Limited. So this is the acquirer, this is the target. Shares issued by the two companies are 10 lakhs and 5 lakhs respectively. So this is the acquirers and this is the target shares. Calculate the increase in the total value of BCD. Who is BCD? BCD is the target, resulting from the acquisition on the basis of the following conditions. So we are saying that BCD independently, how much will be the increase in value for BCD? Current expected growth rate is 7%. However, expected growth rate under the control of AFC is 8% without any additional capital investment or any change in the risk of the operation. This language means that if there is no change in the risk of the operations, that means the KE which was there pre that acquisition continues to remain the same KE even post the acquisition. But how much is the KE pre the acquisition? Well, I don't know. Current market price of AFC, who is the acquirer, is 100, of BCD, that is the target, is 20. So this is the current market price of the target. This is based on the current growth rate. Okay, this is based on the current setup, based on the current growth rate. Post merger the growth rate will change, but the current growth rate, for example, is, let us say, 7%. expected dividend per share of BCD is 0.6. So this is already D1 given to you. Okay, what are you supposed to do to find the increase in the total value of BCD resulting from the transaction? So we will say that, well, over here for BCD, for example, this is question number 5. I will say for BCD, my existing KE is how much? Well, this is based on CAPM ideally, but you don't have data regarding RF, RM or beta. So next best is Gordon, that is existing D1 by existing P0 which I have plus the existing growth. Okay, so this is D1 which is already expected, so that is 0.6 divided by P0 which is equal to 20, which is the current price which is based on the current investor perception, plus growth which is I think 0.07. So this is 0.6 by 20, that's 0.03, and hence this comes to 10%. Now unless given otherwise, we will say that the KE will remain the same because the risk of the operations don't change. So how will be the revised P0 in case a merger announcement happens for BCD? This will still be D1 by KE minus G. D1 is still taken as 0.6. Now a lot of students, they say that 0.6 must have been calculated using the 7% growth. We'll have to rephrase it at 8%. Remember, that is not required whenever D1 is given. If D0 was given, you would have done that. But if D1 is given, you will take the same D1 because ideally the GP starts from the first term to the second term to the third term. First term can be anything, and as a result, if D1 is given, you will directly take that. Divided by KE, we are saying this remains the same minus the revised growth which is probably 8%, and hence 0.6 divided by 0.02 comes to 30. So we are saying that the increase in BCD's value is going to be 30 minus 20, that is equal to 10 per share, and if there are 5 lakh shares in BCD, that comes to 10 into 5, whatever is the total increase in the value of BCD, that is sub point 1. Sub point 2 says, on the basis of the aforesaid conditions, calculate the gain or loss to the shareholders of both the companies if AFC were to offer 1 share for every 4 shares of BCD. So this is impact analysis which is being asked, for which I need to calculate the post-merger market price. Now the general working that I do for the post-merger market price is I find the post-merger EPS into I assume a post-merger PE and find the post-merger market price, which can work if the question remained silent in terms of different growth rates or any other data. But in this question, is it specifically given? Yes. And hence we will say that what will be the post-merger market price? Well, post-merger market price will be the expected value of AFC after the merger plus the expected value of BCD after the merger. We say AFC, there does not appear to be a change in growth or anything. If there was something, we would have taken it, but that does not appear to be, and hence AFC, which is 10 lakhs and value of 100 rupees, which is equal to rupees 1000 lakhs, we will say that this piece of value will remain the same. However, BCD, which is 5 lakhs, which was earlier worth 20, will now be restated at 30 due to the changes in growth, and hence this will be 150 lakhs. So ideally, my post-merger market cap ideally should be 1150. Earlier, you were assuming a P. However, what if the growth changes from 7 to 8 or 7 to 9? Well, the value should be different, and hence this method incorporates that. Divide by the post-merger number of shares. Well, this will still be 10 lakh shares plus 5 lakhs into the exchange ratio of 1 by 4, and hence this is 1,25,000 shares, and hence this is 11.25 lakh shares. So this is 1150 divided by 11.25 comes to around 102.22, which is the post-merger market price per share. And the question asks you to find the gain or loss for both set of shareholders, which will be, let us say, the post-merger market price per share of 102.22. Pre-merger AFC had shares which were worth 100, and hence 2.22 is the gain. However, for BCD, earlier each share was worth 20 rupees before the merger. However, post-merger, if you agree for a share swap, this is going to be worth, for example, 102.22. But do I have 1 share? No. Each shareholder of BCD has gets 0.25 or 1/4 of AFC shares, and hence this will be worth 25.56, and hence 5.56 is again for each shareholder of BCD in case we had to show this. So this is an interesting assessment and to be done when different growth rate data is given. Next, we look at sub point 3. This is cash acquisition, one of the very few places where cash acquisition is looked at. So you have point 3. Calculate the gain to the shareholders of both the companies if AFC pays 22 for each share of BCD. End of story. They are paying 22 rupees for each share of BCD. So 22 rupees paid for each share of BCD, which is worth 20, and hence 2 rupees is again for BCD shareholders. End of story. Sir, I need to find the post-merger MPS. BCD shareholders are not getting shares in the post-acquisition entity. So whatever be the post-merger MPS does not really matter. It is for BCD shareholders. But does it matter to AFC shareholders? Yes. So if different growth rates are given, we will sit and try to calculate the price. However, if you read further, they say assuming P ratio of AFC does not change after the merger. They are giving you a specific instruction and hence you will have to follow that. So now in sub point 3, you have to do the post-merger MPS calculation, taking post-merger EPS of the combined entity into the post-merger P, which is going to remain the same. EPS of AFC is 8 rupees and that of BCD is 2 rupees. It is assumed that AFC invests its cash to earn a 10% return. So now, for finding the gain or loss to AFC shareholder, I'll need to find the post-merger MPS, but this is to be calculated as a post-merger EPS into the post-merger P. Now I don't have the post-merger EPS, but I know that 8 rupees per share is the EPS of AFC and there were 10 lakh shares in AFC, plus in the combined entity 2.5 is the EPS of BCD and there were 5 lakh shares in BCD. Now I might be paying cash to BCD shareholders, but BCD's business ultimately becomes my business and hence I will take over the profits of BCD. So this will be my total profits. There is nothing even regarding synergies. However, there's a cash acquisition. If there's a cash acquisition in the denominator, there's no new shares issued. However, there is cash paid and that cash must be deployed in the business, and that business, how much cash am I paying? Well, 22 rupees per share into 5 lakh shares. So I'm paying 110 and 10% is the income. So 110 into 10% will be my income that I will no longer earn. Remember, if tax rate was given, I will also say that there will be a tax impact, because if I don't earn that income, I will not even pay tax. So over here, this is my income impact. So this is 80 plus, let's say 2.5 into 5, this is equal to 12.5 minus, let us say 11 divided by 10, and hence this is what? I think 81.5 divided by 10, that is 8.15, but this has to be multiplied by the post-merger P ratio, which is the same as the pre-merger P ratio of AFC, which is 100 divided by 8 pre-merger, and hence this must be 12.5. So this is into 12.5, 8.15 into 12.5 comes to, I think, 101.875 minus 100, which was the value, and hence 1.875 is the gain for AFC shareholders. For BCD shareholders, this 101.875 does not matter. They are getting 22 rupees for each of their share, which is worth 20 rupees, and hence they are getting a gain of 2 rupees. So that takes care of question number 5. I would definitely rate this question as an important question because it has an interplay of valuation as well as merger concepts. Now further questions like question number 6, 7, 8 would have, let us say, certain adjustments which are pertaining to demerger, leveraged buyout, etc. So let us review that. This is a demerger question. Remember, in case of demerger, what is happening is there might be a company which has multiple divisions. You are demerging one of the divisions into a new company, and this new company will get the division in return issue shares, either to the company itself or to its shareholders. So if I want to find how many shares must have been issued, I can see the basis if available, or if the question asks me a ratio, one of the best way to do is somehow looking at the data given in the question and trying to find the shares, number of shares in the new company, because these shares must be issued to the shareholders of the original company, and that can help you in calculating the ratio. Let us try to understand this with a question. Following information is regarding Fortune India Limited, having two divisions, that is a pharma division and FMCG division. So two divisions, pharma and FMCG. Paid up share capital of Fortune India is 3000 lakh equity shares of rupees 1 each. This is my existing paid up share capital of Fortune India. Fortune India decides to demerge the pharma division to Fortune Pharma, that is a new company with effect from 1st April 2005, which means up to 31st March 2005, Fortune India comprised of both. From 1st April 2005, it comprises only of the FMCG division. Details of Fortune India as on 31st March 5. You guys tell me, 31st March 5 will include what? Sir, both FMCG plus pharma. If this was Fortune India data given on 1st or 2nd April 2005, it would only be FMCG. And Fortune Pharma as on 1st April 2005, this is only the pharma division, are given below. Your outside liabilities, loans, current liabilities, fixed assets, investments. Last May, we'll make a change over here. our solution will also change. Let's say if instead of miscellaneous expenses, you were given deferred tax items. Institute in the recent study material has made it deferred tax items. That is fine. If it was miscellaneous expenses, it is a fictitious asset. But if it's a deferred tax items, remember it is like a real asset, and Institute takes it in the calculation of net assets. Sir, why? Well, let us say there are carry forward losses in a company that creates a deferred tax asset. If I were to acquire your company which has carry forward losses which were going to lapse, you would say that when you acquire my company, you take my carry forward losses as per the Income Tax Act, and hence if you are taking the benefit of my losses and having a tax saving, you have to pay me something for it, and hence there is an asset, for example. So deferred tax asset, Institute takes it in its net assets calculation. If it was miscellaneous expenses, you would have not taken it. In the printed solution, there is miscellaneous expenses, so it is not taken in the asset minus liability calculation. But if it is deferred tax asset or a deferred tax liability, it should be taken in the net asset calculation. Remember that rule. It is also there in your study material. Board of directors of the company have decided to issue necessary equity shares of Fortune India. Necessary, they don't tell you how many, of ₹1 each, without any consideration to the shareholders of Fortune India. Remember, Fortune India has given the division to Fortune Pharma. We are not giving consideration to Fortune India, we are giving it to the shareholders who are different of Fortune India, and hence these shareholders did not give me anything, but I am still giving them shares because Fortune India gave me the division. For this purpose, the following points are to be considered: transfer of assets and liabilities at book value, estimated profit for the year 5-6. Remember, this is after the demerger, is 11,400 for Fortune India. This must be for the FMCG business, and 1470 for Fortune Pharma, which must be for the pharma business. ठीक है? Estimated market price of Fortune Pharma is 24.5. Okay, and the average PE ratio of the FMCG sector is 42 and pharma sector is 25, which is expected for both the companies. Okay, so you are given the PE ratio. So can I say EPS into PE will actually give you the MPS? Now for pharma, I have the MPS at 24, I have the PE 24.5, P at 25, and hence I can somehow find my EPS. Okay, so if I do the workings, my EPS for the pharma vertical would, I think, be around 0.98. Okay, however, how do you calculate EPS? Well, EPS is calculated as the profit divided by the number of shares. So if I take the profit by shares of pharma, 0.98 should equal to 1470, which is my profit, divided by the shares that must be there in Fortune Pharma. And therefore, based on this data, it appears that there must be 1500 shares in Fortune Pharma, but this is a new company and this company is issuing necessary, that is 1500 shares to the shareholders of Fortune India. How many shares are there in Fortune India? 3000 shares are there in Fortune India. So there are 1500 shares issued by Fortune Pharma to the shareholders of Fortune India. Okay, so you have to find a ratio in which the shares of Fortune Pharma are to be issued to the shareholders of Fortune India. So we are going to say 1500 shares which are issued to the 3000 shareholders of Fortune India, and hence 0.5 share of Fortune Pharma for every 1 share of Fortune India. Second, the expected market price of Fortune India. Expected market price is the market price of the FMCG division. Well, FMCG division has 11,400 lakhs, divided by it has 3000 shares, and hence 11,400 divided by 3000 comes to 3.8 being the EPS into the PE ratio being 42 for FMCG, and hence the expected price is around 159.6, nothing new over here. And the book value per share of both the companies immediately after the demerger. Now, how will you find the book value? Well, you will take the total assets in your printed solution. Because miscellaneous expenses was there, this 200 and this 60 was not taken. However, if you see the revised question set, and that is fine, there is no amendment per se. If you see the revised question set in the institute material where there is deferred tax items, they have taken it because it is a deferred tax item. So if I were to take it, I will say 20,400 plus 12,300 plus 30,200 plus 7,300 minus 200, that is 70,000 will be my total assets. If I take it as miscellaneous expenses, I will not take 200, and my liabilities will be 3,800 and 21,000. I think they have made it 21,200 also over here, but nevertheless, your numbers even in the main exam can be slightly different. So basically, 70,000 minus 24,800 will be 45,200. This will be 45,200 for Fortune India. However, this is on 31st March 2005, which is including FMCG as well as pharma division both. When I look at pharma, this is 7740, 7600, 8800, 900. If you take it as deferred tax, add 60. If you take it as miscellaneous expenses, don't add this. Minus 2400, minus 1400, minus 1300 comes to around 20,000. So all said and done, this is, let's say, 20,000. So I can say that if 45,200 is the net assets of the total, out of which 20,000 is pharma, the remaining 25,200 must be FMCG. So for FMCG, that is Fortune India Limited after the merger, and for pharma, which is Fortune Pharma Limited after the demerger, this is 20,000. There may be a slight change in your PDF where you might see 20,200 or something because it was treated as miscellaneous expenses. But I just want to give you an alternative presentation if deferred tax is given instead of miscellaneous expenses. If both are given, then you usually take it as deferred tax and solve. Divided by 1500 shares, and you have, let us say, 45,200 minus 20,000, that is 25,200 divided by 3,000, which is there in Fortune India. So this is 25,200 divided by 3,000 comes to around, I think, 8.4, and 20,000 divided by 1500, which comes to around 13.33. Slight differences would be there because over here when you take your total assets, these are total assets which are without adjusting this deferred tax minus the liabilities, and approximately you will get 8.49 and 13.29, which is a slightly different answer. If you want, you can just keep a note that if there is deferred tax, include in net assets working. ICI has done this in both a merger question as well as a business valuation question, and hence one can always argue that, sir, practically we take or we don't take, that is debatable. But from an exam perspective, if there's a deferred tax asset or a deferred tax liability, ICI has taken in both these places. One question in business valuation and one question in mergers. Okay. Next is question number 7. This is a question pertaining to buyout. There is a fair bit of calculation over here, but one very important thing over here is, what if you are given that there is a loan that is taken and the loan is repaid at the end of 8 years? Perfect, then there is no problem. Interest will be paid each year, loan is repaid at the end of 8 years. What if you are told that there is a loan of 500 but the principal is going to be repaid each year? Then 100 rupees is going to be repaid in the first, second, third, fourth year for principal, and your interest will accordingly change. But what if the question tells you that the loan is going to be repaid in equal installments of principal and interest both? Not just in this problem, across your course, if you have to find the equated annualized installment, how will you do that? Well, equated annualized installment will be calculated as loan divided by the PVAF at the rate of interest pre-tax for the number of years in the loan. This is based on the IRR concept. From the banker's perspective, we will say that IRR says that the present value of cash outflows should be equal to the present value of cash inflows. So if this is a working done from the bank's perspective, then from the bank's perspective, we will say that if I am giving you a 100 rupee loan today and I want to earn a 10% rate of interest and you are going to repay me money over 5 years, I will say that at IRR, when I give you 100 PVCO and you are giving me X amount each year, I don't know what that X amount is, but into the PVAF, I want to earn 10% over a 5-year period. Then if I rearrange this 100 that is a loan upon the PVAF will give you the equated annualized installment that is applied. That concept is applied over here. Let us review question number 7. Personal Computers Division of Distress, a computer hardware manufacturing company, has started facing financial difficulties for the last 2 to 3 years. There's just a story. Management of the division headed by Mr. Smith, who is interested in buyout on 1st April 2013. So you want to buy out this division from the company. However, to make this buyout successful, there's an urgent need to attract substantial funds from venture capitalists, because maybe the management does not have enough money to buy out the entire division. So VenCap, a European venture capitalist firm, has shown interest in the proposed buyout. Distress, which is interested to sell the division for 180 crores. So VenCap says that, okay, I'll arrange some funds we need to pay 180 crores to acquire this personal computer division. We'll form a new company which has this division, but Mr. Smith is of the opinion that an additional amount of 85 crores will be required to make its division viable. So 180 though we'll have to pay to the seller, Distress Limited, so that we acquire the division, but we have to turn around a lot of things in the division, and hence we'll need another 85 crores. That's a total of 180 plus 85, that is 265 crores. The expected financing pattern will be as follows. Management, like Mr. Smith, shares of rupees 10 each, 60 crores. That means there must be 6 crore shares of rupees 10 each. Equity shares given to Vencap of rupees 10 each, 22.5, that is 2.25 crore shares of rupees 10 each. Okay. 9% debentures with an attached warrant of 100 each. Warrant is 100 rupees. Total debentures are 22.5. So these are 0.225 crore debentures of rupees 100 each. So there are 0.225 crore debentures, and each debenture has an attached warrant. There must be 0.225 crore warrants. And then there is an 8% loan, and this total financing comes to 265 crores. The warrants can be exercised at any time after 4 years for 10 equity shares at the rate rupees 120 per share. So Vencap, who has these warrants, maybe 0.225 crore warrants, after 4 years can convert them into 10 equity shares, and hence in return get around 2.25 crore equity shares, but this will not be free of cost. They will have to pay 120 crore per share, let us say after 4 years. Fair enough. The loan is repayable at one go at the end of 8th year. What are we talking about? Sir, the loan, this amount. But the debentures are repayable in equal installment consisting both principal and interest over a period of 6 years. What are we talking about, sir? These debentures. Now the problem is debentures are repayable in equal installments of principal and interest. We don't know what is the amount. For loan we don't have to bother. Nothing is repaid over 8 years, but in debentures of 22.5 crores divided by the PVAF at the rate of, how much does the bank want to earn? Debenture holder wants to earn 9% for a period of 6 years. So 1 divided by 1.09, 1, 2, 3, 4, 5, 6, and you get around 4.4859. So if I divide this and 22.5 divided by this, I think I get around 5.02 approximately. This is the equated annualized installment that you will pay in each of the year over the 6-year period. Mr. Smith is of the view that proposed dividend shall not be kept at more than 12.5% of the distributable profits. This is like the payout ratio. Usually dividend is a percentage of face value. Here it is a percentage of distributable profits for the first 4 years. The forecasted EBIT after the proposed buyout is as follows. Okay, you have EBIT for 4 years. Okay, applicable tax rate is 35%, and it is expected that it shall remain unchanged at least for 5 to 6 years. So that is the tax rate. EBIT message we'll have to subtract interest. That will give us, let us say, the EBT, from which I subtract tax, which will give me the PAT, from which I will subtract, let us say, 12.5%, which will give me the retained profits in each year. Okay, in order to attract Vencap, Mr. Smith had stated that the book value of equity shall increase by 20% during the above 4-year period, that is 20% per annum unless otherwise given. Although Vencap has shown their interest in the investment, but they are doubtful about the projections of the growth as per Mr. Smith. So Vencap demanded warrant should be convertible into 18 shares instead of 10. Okay, so this is just the general data. There's a claim made by Mr. Smith that the book value of equity will grow by 20% each year. But sir, what is the book value of equity? Well, we are acquiring personal computers division of Distress Limited, and now we are setting up a new company on 1st April 2013. So on 1st April 13, if I were to go to see what is the book value of equity, this will be made up of equity share capital plus reserves. If it is a new company, there will be no reserves, and hence on 1st April 2013, if I go to see on 1st April 13, the equity share capital, for example, is going to be what? Well, 60 crores given to Mr. Smith and 22.5 crores with Vencap, that is 82.5. Are there any reserves? The answer is no, and hence your book value of equity, see, there is 22.5 crores of debt, 160 crores of loan, that is 182.5 of borrowings. It's not a part of your equity. So 82.5 crores is your equity. We are claiming that this will grow at the rate of 20% per annum. But why should it grow? Well, it will grow because of profits earned. But do I have the retained profits? No, that is what I have to find. EBIT minus interest minus tax minus your dividend, etc. You are required to determine whether or not the book value is expected to grow by 20% each year. Further, you have been appointed by Mr. Smith to advise whether you would suggest to accept the demand of VenCap of 18 shares instead of 10. Here the conclusion is given assuming, so we have added this, assuming management is not willing to give up control. So there are two things that you have to prove. First, whether the book value is actually growing by 20% each year. Now, how do I do that? Well, if I do it for 1 or 2 years, you should be able to do for the other years. Let's say for the year 13-14, I have my EBIT at 48 crores. Why should it reduce, sir? Because of interest. On the loan, that is 160 into 8% comes to 12.8 in the first year, also comes to 12.8 in the second year, third year, fourth year. But when I go to debentures, well, I don't know the interest on debenture. This is 9%. Opening will be 22.5 into 9% comes to 2.03. Let us say in the first year. And hence, your EBT will be 48 minus 12.8 minus 2.03 comes to around 33.17. Tax rate has been given to you as 35%, which is expected to remain constant, and hence your PAT comes to 21.56, on which you will distribute 12.5% of the distributed profit as dividend, and hence 18.86 or 87 will be your retained earnings during the year. So if I go to see on 31st March 2017 or 31st March 2014, I will look at my opening balance. My opening balance is 82.5, on which there will be some retained earnings during the year, which is 18.87 approximately, which is 82.5 plus 18.87 comes to around 101.37. Okay. Now, is that a growth of 20%? Well, 101.37 minus 82.5 upon 82.5 in percentage comes to around 22.87 or something. Is that greater than 20? Yes. Now, I'll do a similar working for 31st March 2015, but this is where I will get stuck. I know that the EBIT is 57. However, I don't know what is the interest. Well, can I say 2.03 remaining the same? No. So, I'll have to prepare an amortization table for the debentures where I will say opening was 22.5, on which 2.03 was the interest of the first year, but 5.02 was repaid, and hence the closing balance will be 22.5 plus 2.03 minus 5.02 comes to 19.51, and 19.51 into, for example, 9% comes to around 1.76, and similarly you will do the working for all the other years as well. So if I go 57 minus 12.8 minus 1.76 comes to around 42.44 minus 35% around 27.59 minus 12.5% 24.14. This is my retained profit. So I will say that okay, in the next year my opening is 101.37, but further I have retained 24.14, and hence if I total this, it comes to around 125.51. Now in percentage, 125.51 minus 101.37 upon 101.37 in percentage comes to around 23.82, and so on. So basically I will keep on doing this working for 4 years and try to find the growth. So over here this is 22, this is 23 as we just found. Other 2 years if you do the working, again this is 24 and so on. So every year the growth is greater than 20%, and hence the contention of Mr. Smith is correct. Your important working over here would be to calculate this EI of debentures so that you can use this 5.02 and then find the future interest as well. You do need to do this only for 4 years, so the debentures will continue for 6 years and the loan for 8 years. We need to comment only for the first 4 years. So we say that the contention of Mr. Smith is correct. Further, they are saying that they want 18 instead of 10. So if they take 18 into 0.225, VenCap takes 18 into 0.225 crore debentures, so there will be 0.225 crore warrants. They will get 4.05 crore shares. They will have to pay money, yes, no one is denying that. But if management does not want to give up control, then 4 years later, what will happen? Well, Mr. Smith will still have 6 crore shares. However, VenCap will have 2.25 crores plus over here 4.05 crores, and hence this will be 6.3, and hence the control will be shifted to VenCap, and hence Mr. Smith will not be agreeing to this ratio because Mr. Smith does not want to give up control. Okay, question number 8. This is a question on EVA. Uh, Now, EVA is more of a business valuation concept as well, but some sums are also there in mergers. So we are discussing this over here only. But yes, you should do a little more practice for EVA because it is very, very scoring. It's not inherently directly linked to a merger concept per se. So following information is given for 3 companies that are identical in all respects except for their capital structure. So you have orange, grape and apple. You have data given, invested capital, debt to assets ratio is given as 0.8, which means debt must be 80, equity must be 20. 50, then debt must be 50, equity must be 50, and last, this is debt is 0.2, so debt must be 20. Shares outstanding are given, pre-tax cost of debt is given, cost of equity is also there, and operating profit, that is EBIT, coincidentally same. Tax rate is uniform for all the 3 companies, that is 35%. Calculate the WACC for each company. So let us say if I do the working for orange, if I am able to solve for orange, I should be able to solve for grape and apple as well. So if I want to find the WACC, that is the cost of debt, that is 16% into 1 minus 0.35 KDs after tax into the weight of debt, that is 0.8, plus cost of equity, which is 26%, into the weight of equity, which is 0.2, and then 16 into 0.65 into 0.8 M plus 26 into 0.2 M plus MRC, I think 13.52%. Okay, similar working you will do for grape and apple as well. Second, compute the EVA for each company. So if I want to do the EVA, EVA is NOPAT, net operating profit after tax, that is 25,000 into 1 minus 0.35, that is one of the methods, minus invested capital, which is 1 lakh, into the WACC, which is 13.52%, which we just calculated. So 25,000 into 0.65 comes to around 16,250 minus 13,520. So this is minus 13,520 and you get an EVA of 2730. Great. Based on EVA, which would be considered as best? Well, ideally higher the EVA, the better it is. So whichever company gives me the highest EVA. So over here, first company EVA is 2730, 1020 and negative 700. So you will select orange. Point 4, if the industry P ratio is 11, estimate the price of the share of each company. Now, how do I find the price of the share? Well, EPS into P, because there is no growth rate or any other data given, P ratio is given. So, EPS into P. So, how will I find the EPS? Well, EBIT is 25,000 minus interest. Now, how do I find the interest? Well, debt is 80,000. 80,000 into the rate is 16%. So, 80,000 into 16% comes to, let us say, 12,800. So, this is my EBT, which is 12,200. Now 12,200 minus a 35% tax rate, which comes to 7,930. Now 7,930 is the profit divided by number of shares, that is 6,100, and hence divided by 6,100 comes to, I think, 1.3 being EPS into 11 being the P, and hence I think 14.3 will be my market price. Calculate the estimated market capitalization for each company. So you will multiply with the number of shares, which is 6,100, and you will get around 87,230 to be the market cap. So if I go to see 14.3 and 87,230. In EVA, a few other things that you might need to remember is sometimes the question might ask you to calculate MVA. That is the market cap of equity plus the market value of debt minus the invested capital as per book value. Or question might give you adjustments like provision for bad debts, in which case for calculating NOPAT, you will add the provision for bad debt without tax adjustment in line with ICI solution. For calculating the invested capital along with equity or retained earnings, you will add your provision for bad debts which must have been charged and do the working. Or there might be some unrecognized assets, like due to research and development expenditure expense, nothing is shown as your asset and your reserves are lower, but there are certain assets in your books which are unrecognized. You will add that to the invested capital and do the working. This is a few additional adjustments possible. Next we have this question number 9, which is on I would say comparable company workings, where XY is a cement manufacturing company like JSW Cements, for example, hired you as a financial consultant of the company. The cement industry is very stable. for some time and the cement companies SK and AS are similar in size. Like for example, you have a company Ultratech Cement and you have a company Ambuja Cement which are listed, which are similar in size, have similar product market characteristics. Use comparable method to find the value of XY. In performing the analysis, use the following ratios. So you have these ratios: market to book value, market to replacement cost, market to sales, market to net income, and following data are available for your analysis. So for SK, market to book value comes to 450 divided by 400, that is 1.125. For AS, this is 400 divided by 300 comes to 1.333. Achha, but for XY Limited, I have 250 which is the book value. However, in the market, SK has a value of 1.125 times its book value, AS has a value of 1.33 times its book value. So if I were to take the average industry multiple, this is 1.125 plus 1.333 divided by 2 comes to 1.125 plus 1.333 divided by 2 comes to 1.1229. So on an average, we are saying for every 1 rupee of book value, the market value is 1.229 times, but XY has 250 of book value. So 250 into 1.229 equals to 307.25. This is one of the possible values. Other value is 450 divided by 600. This is market to replacement cost. 450 by 600 comes to around 0.75, and AS के लिए 400 divided by 550 comes to around 0.73. So if I take an average, it is 0.74. So we are saying that for every 1 rupee of replacement cost, market value is 0.74 times, but we have 500 into 0.74, the value is around 370. Third, divided by sales, market to sales, 450 divided by 550, 0.82, 400 divided by 450, 0.89. So if I take an average, 8982 divided by 2, 0.86, let us say approximately 500 into 0.86 comes to 430 approx. And lastly, to net income, 450 divided by 18 comes to a multiple of 25, and 400 divided by 16 also comes to a multiple of 25. So average will be 25 into 14 comes to 350. Now I have 4 different values. I don't know which of them is the final. So I will take a simple average of all of them. 307.5 plus 370 plus 430 plus 350 divided by 4, and that will give me the final average valuation considering all of these values. Okay. So this takes care of question number 9. This is on comparable company method. Next you have this question number 10. This is largely a valuation question, but can also come in mergers. A couple of similar sums are also there. So let us review this once. Now it's a different type of a question. This ABC company is considering a new sales strategy that will be valid for the next 4 years, 3 years, 4 years, 5 years, whatever. They want to know the value of the new strategy. Achha, we have done company valuation, we have done capital budget project valuation, but this is strategy valuation. Okay, how do you value a strategy? Well, strategy valuation is nothing but valuing a company under the existing base minus again valuing the company under the new strategy. The difference in the values, if any, is due to the strategy employed. Following information is given relating to the year which has just ended. So this is past data. Sales, gross margin is 20%, so 20,000 into 20% seems to be 4,000. Okay. Admin and selling expenses are given in percentage, so this must be percentage of sales. So this is maybe 2,000. That is 20,000 into 10% gives you 2,000, and hence 4,000 minus 2,000 gives you PBT of 2,000. So 2,000, which is a PBT, into 30% will give you the tax rate, tax amount of 600, and hence your PAT is 1,400. Then you have balance sheet information of fixed assets, current assets and equity. Fair enough. Achha, an interesting thing to see over here is your fixed and current assets total up to 12,000. That means your total assets are 12,000, equity is also 12,000, which means How much debt must be there? 0, because the entire assets are financed by equity only. If it adopts the new strategy, sales will grow at the rate of 20% per annum for the first 3 years. Again, if it adopts the new strategy, sales will grow at the rate of 20% per annum for 3 years. From the 4th year onwards, it will stabilize. The gross margin ratio, that is 20%. The assets turnover ratio. Now, how do you calculate assets turnover? Sales divided by assets. Here you have assets being current assets and fixed assets, and the capital structure, that is debt and equity, and income tax would remain unchanged. So basically this is the important thing, your asset turnover ratio will remain unchanged. Depreciation will be at the rate of 10% of the fixed assets at the beginning of the year, and company's target rate of return is 15%. Determine the incremental value on adoption of the new strategy. Now, how do you do strategy valuation? That is basically company valuation. How do you value company? Based on the present value of future cash flows, where cash flows in year 1 to 3 will be different. However, from year 4 onwards, they will stabilize. So you can use the perpetual growth model. So over here, your first objective is to find PAT. Acha, pehle to we will find sales in year 1, 2 and 3. They are growing by 20%. So 20,000 hai, growing by 20%, that is 24, 28.8 and 28.8 plus 20% becomes 34.56. Later they will stabilize. So year 4, if I want to find for terminal value calculation, this is 34.56. Now PAT, if I go to see, my gross margin is going to remain the same, my expense percentages are remaining the same, and my tax rate is remaining the same. So what is my existing PAT? Sir, my existing PAT is 1400 on a 20,000 sales, that is 7%. Now if my gross margin remains the same, assuming my admin selling expenses are also a percentage of sales, they remain the same, and my tax rate also remains the same, so my PAT percentage will also remain the same. So my PAT at the rate of 7% will be 24,000 into 7% comes to 1680, 28,800 into 7% comes to 2016, 34,560 into 7% comes to 2419, and this will remain the same, stable. To this you ideally have to add back depreciation. Acha, there is no debt, so interest का कोई question नहीं है. Minus you will have to subtract capex or increase in fixed assets. Capex, and then you have to subtract increase or decrease in working capital. This will give you the free cash flows. Here form and equity is one and the same because there is no debt. Discount this at the rate of 15% to find the present value of cash flows, at least for the first 3 years. 4th year I will use for the purpose of terminal value calculation. But the problem is the question does not tell me specifically regarding capex or working capital, but it tells me that my turnover ratios remain the same. So let us say if I had to find the current assets turnover ratio, that is sales by current assets. So existing, my sales are 20,000, my existing current assets are 4,000, and hence 5 will be my turnover ratio. Therefore, if I want to find current assets for year 1, that current assets for year 1 can be calculated as, you can say that the turnover ratio remains the same. I can take the turnover down and I can take the current assets at the top. So this will be sales for year 1 upon the current asset turnover ratio for year 1, which is the same, but sales are 24,000 upon the turnover will be 5. So my current assets required would be 24,000 divided by 5, that is 4,800. But at year 0, this is my year 1, my current assets were 4,000, and hence there seems to be an increase in working capital by 800. Similar working for the second year would be sales of 28,800 divided by 5. 28,800 divided by 5 comes to 5,760 minus 4,800, an increase of 960. Current assets of year 3, 34,560 divided by 5. 34,560 divided by 5 comes to, I think, 6,912 minus 5,760 comes to around 1,152. Okay, so this is your increase. If I go to the current assets of year 4, this is still 34,560 divided by 5, this is 6,912, and hence there is no further increase. So I can find the increase in current assets as 800 in the first year, 960 in the second year, 1152 in the third year, and no further increase from the fourth year. Now comes the problem of fixed assets. So when you look at fixed assets, again my fixed asset turnover has to remain the same. So what is my existing fixed assets turnover? It is fixed assets turnover would be currently 20,000 divided by, I think, 8,000, and hence this is 2.5. Again, if I have to rearrange and if I want to find the fixed assets for year 1, that will be sales, that is 24,000 for year 1 divided by this 2.5, that is a ratio, and hence 24,000 divided by 2.5 comes to 9,600. Now, how do you solve this? There's a challenge over here. If I look at fixed assets for year 0, that is actually 8,000. So technically there seems to be a net increase of 1600. If I go to fixed assets of year 2, this is 28,800 divided by 2.5 comes to 28,800 divided by 2.5 comes to around 11,520 minus 9,600. This is 1920. Year 3, 34,560 divided by 2.5, 34,560 divided by 2.5 comes to 13,824, an increase of 2304 if I am not wrong. And lastly, if I go to year 4, again this is the same value, which is 13,824, and hence there is no increase. Now a student might say, okay, this is my increase. However, here what is happening is my fixed assets depreciate, current assets don't. So if I look at my opening balance of fixed assets is 8,000, but my closing balance needs to be 9,600. However, there will be some depreciation which is given to you as 10% of 8,000, and hence this comes to 800, which means if I were to find the balancing figure, this is the amount, let's say to bank. If I go to see, this is 2,400. So ideally, how do I solve this? I either add back depreciation, which is worth 800 in the first year, and subtract capex, that is an actual increase in fixed assets of 2,400. Now I am not actually sitting and preparing a cash flow statement as per AS3 or Ind AS 7. I want to find my free cash flows. I can say with confidence that over here my net change of 1600 is due to adding of depreciation and subtracting of capex. So either I calculate the depreciation, calculate the capex and show both of them, or if I am confident and conceptually clear for both of these, net amount I will say this is a net 1600. Sir, वैसे net 1600 क्यों है? 2400 of capex and 800 add back of depreciation. I can also verify this for another year. Let's say opening is 9,600, 960 must be my depreciation, closing has to be 11,520, which means if I find the balancing figure 11,520 plus 960 minus 9,600, this is 2,880. So I can say, okay, I will take 2,880 deduction as capex and 960 add back as depreciation. So I'll add back 960, deduct 2880, ultimately 960 minus 2880 comes to what? Sir, 1920. Can I directly calculate it? Yes. So Institute has done this directly. If you're comfortable, you can also take this directly, but don't make the mistake of taking this and depreciation both. When you take 1600, uske andar automatically the plus 800 as well as minus 2400 both have come. So don't make the mistake of taking depreciation. Achha, if you're taking gross depreciation, then you take the gross capex as well. If you're taking capex net of depreciation, then you directly take 1600, 1920, 2304 and less. After that, you have a steady state. Some people say, nahi, even after 4 years, there will be depreciation. हाँ, जितना depreciation होगा, उतना ही capex होगा. It is like a steady state over here. So if there's 800 of depreciation, there's be 800 of capex. And both of them will nullify. So that ways you can now find the free cash flows. So this is 1680 minus 1600 minus 800 comes to I think 720 negative. Second year 2016 minus 1920 minus 960, 864 negative. So you are burning cash. This is what startups do. Initially they spend to increase their sales, and then later at a later stage when they stabilize they actually make profit. I think this is 2419 minus 2304 minus 1152 comes to around 1037 or something, if I'm not wrong. अच्छा, लास्ट में दिस इज 2419. सो फॉर टर्मिनल वैल्यू कैलकुलेशन आई विल टेक 2419. ऐसा नहीं कि भाई ईयर 3 में जो हो रहा है दैट सेम एडिशनल कैपेक्स विल कंटिन्यू इन ईयर 4 एज वेल, एंड हेंस आई विल डू अ सेपरेट वर्किंग फॉर ईयर 4. इन सच केसेस आई विल डिस्काउंट दिस एट द रेट ऑफ 15%, and for 2419 this will stabilize divided by 0.15 minus g will give you the terminal value at the end of the third year. D4 by ke minus g will give you P3, and hence this will come to around 16,127, which you will take at present value basis for the third year. So when we look at the workings here, we will find 720, 864, 1037. Here they have done the gross working. A shortcut can be possible where you even take the net working. So you will find the present value of the future cash flows. So the first 3 years it is negative, and then the terminal value which is positive but based on year 4 cash flow. So you will get the value at year 3. D4 by KE minus G gives you P3. So you'll have to find a value based on the third year's discounting factor, and 8643 is the value of the entire company under the new strategy. However, the company would still have value under the existing strategy. Well, under the existing strategy, probably there would be no sales growth. So this will continue to be 20,000 up to perpetuity. Profit will continue to be 1400. There will be no change in the profit. So if I were to find a value of my company under the existing strategy, I will say my PAT will be, for example, 1400 only. But sir, I want to find the free cash flows. Okay, in which case my asset turnover ratios remain the same. So my fixed assets have to be 8,000 and my current assets have to be same, that is 4,000 only. So there's no increase investment in current assets. However, when I look at the fixed assets, my opening will be 8,000, 800 will be depreciation, closing will be 8,000, so another 800 will be capex. So basically 1400 if I go to see gross method plus 800 of depreciation, net 800 of capex, or I take the net method if I don't take anything as well. So this PAT is my free cash flow, which is possible. We have done this in question 4 as well. It's a reasonable assumption sometimes in a steady state company to say PAT is your free cash flow, like you can see over here. And this will continue till perpetuity. So the value today will be 1400 into 1.0 divided by 0.15 minus G. So 1400 divided by 0.15 comes to around 9,333. My value of the company under the new strategy is around 8,400, 8,600. Under the existing strategy, the value probably is coming up to, there are a lot of workings over here. The value is coming up to 9,333. So under the new strategy, the value of the company actually falls. So आपका मेहनत पानी में गया. The new strategy does not result in more value. In fact, it reduces the value. So this kind of takes care of the discussion of important chapter questions on mergers. If you see the heading of this chapter, it is mergers, acquisitions, and restructuring. So institute material also has one sum which is on restructuring. Restructuring, when they say, they mean internal reconstruction. It is exactly internal reconstruction that you do in your CA Inter, where you prepare a capital reduction or a restructuring account, and they might ask you to kind of prepare a restructured balance sheet, that is equity shares of rupees 10 each become shares of rupees 2, loans forego let's say 5 rupees, etc. And the balancing figure in the capital reduction account has to go to the capital reserve. So if a restructuring question comes, solve it as if it is a classic same internal reconstruction question of your CA Inter, and you should be done with that one possible question that can come for restructuring, which is there in the study material. It is a simple straight restructuring internal reco question. Okay, so that I think takes care of this chapter on mergers. I hope this video has been helpful to you. If yes, please do like, share, and subscribe to our channel. Wish you all the very best. Keep studying, keep working hard, and I'll see you soon with more such videos. Till then, good luck, goodbye, and take care. God bless you guys.